Let's welcome in our guest. We have Mahantesh Sabarad, Head Retail Research at SBICap Securities, who's joining us from Mumbai. Mahantesh, thank you so much for being with us on NDTV Profit. Now, you've liked consumer names and, we've got the news of this buyout of Lloyd by Havells coming through. Now, what would you do with some of the consumer electrics names at this point of time? Do you think anyone is offering a good opportunity, given that the GST will come through? And, it will change the entire dynamics for this space.
Yeah, of course, you talked of an important development that is upcoming for the sector, the consumer durable sector, which is GST, and therefore, irrespective of what we have seen in terms of the demonetization effect affecting most of these consumer durables for a short period of time, we are hoping that with the GST coming in structurally, these companies will start doing really well. So what it does from the GST point of view for them is it structurally reduces their logistics costs. One of the disadvantages that consumer durables thus far had was multiple points of taxation and associated logistic costs. While taxation, we don't know the tax rates under GST, so while taxation is assumed to be near static between pre-GST and post-GST, the cost structure having come down will definitely mean good news for the industry as a whole, and therefore some of the consumer durable names can do well. What needs to be looked at in these companies is the extent of distribution reach that they have, the extent of brand recall that they have, and their ability to generate free cash flows. That's going to be vital when we look at any stock picks. So without getting into particular names as such, the air conditioning space, the room air conditioning space is something which will secularly grow because it's an underpenetrated kind of market. So stocks in that sector or that segment can be looked at.
All right, but what about the fact that, once the GST comes through, some of the unorganized players are going to find it tough. Some may look to shut shop, some may look to sell out. Do you think M&A action may increase on the back of that? Do you see some of these names becoming bigger? Will that scale help and improve their margins further? Any of the names or players there, do you think could work on this strategy? Do they have the resources to be able to do this profitably?
So you touched upon the M&A activity post GST. Of course, the informal sector or unorganized sector is going to face the brunt of the GST because they will suddenly come into the taxation bracket. But that doesn't necessarily mean that the M&A activity will rise, because for an organized player, if he has all the strategic pieces in place, a good distribution network, a fairly robust brand, then there is no need to acquire any additional brands or additional distribution legs. In such a situation, I don't think M&A activity is going to rise. In fact, if an organized player pursues an M&A activity just to build up scale, then in the interim it is going to be free cash flow negative, and therefore one has to look at it from a case-to-case basis to really say that, okay, this particular M&A activity is going to be accretive for the shareholders, and therefore the stock should rise. So I would generally be very cautious about upcoming M&A activities in that space.
Right. From here on, do you think the markets are headed higher, and will one have to be more stock specific? What do you think will be the themes that will work well from here on?
Since the market is already very high, you have to look at the valuation. So the valuation for the Nifty, for example, is not very cheap. Now we are touching 17 multiples on a forward kind of basis. So it's pretty high. And if the earnings growth is not going to come in, the markets appear quite expensive. So right now, yes, what you mentioned is it a stock pickers market? Yes, you have to do specific stock picks now. Focus more on the earnings, quality of earnings and the earnings CAGR in the next 2 years, and pick those sectors or those stocks which have a fairly good visibility in terms of earnings. Valuation shouldn't be a challenge for some of these companies, even if it is appearing expensive to the underlying index components or any of the peer players. If there is fair degree of earnings visibility, that's the stock we should be backing.
Right. And which themes do you think will definitely have that earnings visibility going ahead? Would it be banks? Do you think the turnaround is going to happen in the NPA cycle and capex will pick up? Will it be auto? Do you think the demonetization effect is over? What are the themes where you think the earnings visibility is very clear?
So there are 2-3 sectors which will immediately come to mind where the earnings trajectory can be better in the years ahead. One of which you named is banks. Banks have classically suffered from structurally weak, not only structurally weak earnings, but also weak quality of their books, the advances book. As we look forward, one of the issue is going to get addressed, which is the weak earnings. That means credit growth is going to grow faster, and we will have expansion in NIMs. Along the way, hopefully the quality of the book will also improve. So we will see a big earnings visibility for the banks, and therefore structurally they become far better as we move ahead. We have to look at consumer centric kind of banks because the major growth on the credit side is going to come from that sector, where the asset quality necessarily remains healthy. Again, consumer centric names, autos that you mentioned, and within autos it's actually got to do with the two-wheeler space, because the demonetization effect has had a telling effect on the automobile companies, and they should be now growing with volumes catching up, and therefore earnings visibility growing. The third sector that really comes to mind in this space at this time is the NBFC space, which is consumer centric. So be it housing finance linked companies or consumer financing linked companies. So these are the sectors that we would like to remain with, generally speaking, in the years ahead, because these promise to have better earnings visibility.
Right. So, consumer linked NBFCs or financials, don't you think they are also pretty expensive versus their averages?
Not really, Pankaj. You have to look at it from this perspective that thus far most of these housing finance companies really lacked scale, or thus far the consumer financing companies had lacked scale. 3 years ago, 4 years ago, some of these companies were sub 50,000 market capitalization kind of sub 50,000 crore market cap. Now some of these are rising beyond 50,000 crore market cap or are about to do that. So in such a situation, scale suddenly becomes important, because their ability to raise capital, their ability to grow, their ability to command premium starts seeping in, and therefore valuation is not a challenge. We wouldn't look at it like you mentioned, they're expensive. For a sub 50,000 crore market cap, I think they're not so expensive.
Right. In terms of the growth opportunity for these NBFCs, it continues to be large and or very, very big, and that's the key reason to buy them.
Yes, it is very large because a lot of small developments are happening in that particular space. Consumer financing penetration is very low. If you look at automobiles, for example, then in the two-wheeler side, probably yes, the penetration is very high. But if you look at the car space, the penetration is in the 60s to 70s kind of range. If you look at the two-wheeler space, is probably 75, 80, but it's still not very large. If you look at consumer durables, then the consumer financing penetration is probably less than 30%. So there is a wide scope to grow. Even in housing finance, the consumer financing for top-up loans, for housing associated house building loans, for home improvement loans, not necessarily the classic first-time buyer kind of loan. We are talking about the second home loan. We are talking about the home improvement loan. We are talking about a house building kind of loan. These products, sub-products within that space, are really very underpenetrated. So we see immense scope for most of these finance companies.
Right. So, one of the key arguments, Mahantesh, to buy these names in the last few years have been what happens to the interest rates. But now that interest rates have stopped coming down, do you think that cost of funding tailwind is behind?
Yes, in a way you're right, because this policy decision by the RBI was quite surprising. They moved to the neutral policy stance, and therefore, in a way, it has put a stop to falling interest rates. I'm no expert on the interest rates per se in terms of the forecast thereof, but one thing is very clear, that the inflation is going to moderate or remain at these 4% plus or minus kind of levels, and therefore, even if we assume that the RBI is not going to change interest rates or bring them down, we are going to live with this low interest rate environment for a considerable period of time. And if that is so, then we will see most of these finance companies, including banks, sit on low-cost funds, and the moment their ability or their valuations go up, their market capitalization size goes up, then their ability to raise funds and buttress the capital side is going to be enhanced, and therefore they look poised for the next phase of growth.
Right. So what would you buy into, say, consumer finance or consumer companies? What are your top picks?
So there are very small names to very large names that we would really look at. So some of the small names that we have alluded to earlier as well has been a company like Capital Trust, which is a small NBFC located in Delhi, to such companies as an Arman Financials, for example, to even such companies as on the well-known name kind are the likes of a Magma Finance, who
Magma FinCorp, you mean?
Yeah, Magma FinCorp. So these are some of the few names. Of course, there are larger names also, where when I talked of the 50,000 crore market cap kind of ability, there are the larger names. The Bajaj Finance, for example, is one key name that comes to mind. And then there is an upcoming finance company like Capital First. So all these are the ones which look attractive. Canfin Homes, another one, which appears very good.
Right. Can you just talk to us about Tata Motors as well? What happened in results, the reaction? Does that make it a buy?
Okay, the results were of course terrible. Okay, that's no second thoughts about it. And the way the management has come across suggests that the hedges that they have been taking on an ongoing rolling basis are not going to be favorable for the next couple of quarters, probably 3 more quarters. So that being the situation, the outlook for Tata Motors does seem a little bad. Here I'm talking about the hedges of JLR, by the way, just to clarify. But then the domestic business is emerging from the rut that they have had over the past 4-5 years. Good passenger car products, now targeting better market share in the commercial vehicles, upcoming defense orders, etc., make the outlook very positive for the domestic business. JLR, of course, has no problem in terms of its outlook and growth. The growth is going to continue to be there. Their product pipelines remain strong, given the fact that they have been spending huge amount of money in R&D. Plus, they are diversifying their production base with a plant in Slovakia, for example, coming up. All this makes the future for Tata Motors very bright, but between the terrible results and the stocks correction that has happened from roughly about 500 odd levels to 450 odd levels that the stock has corrected, makes it an even chance for the stock to actually start growing. So for a really long-term investor who is not really looking at the next 2-3 quarters possible surprises on the downside due to the hedges on the pound, should start looking at a Tata Motors.
Right. How would you look at some of the metal packs and the way some of these companies have reacted to their numbers? Do you think metals as a pack continues to look very attractive? I'm talking about large cap names like Hindalco, Tata Steel, where a lot of debt issues can solve if the prices continue to remain where the prices of metals are.
That's a good question you asked. See, most of the metal companies in India particularly are in trouble because of the high levels of debt that they are straddled with. Be it a Hindalco on the non-ferrous side or be it a Tata Steel on the ferrous side, debt is a big concern. And the way the debt levels are, a few quarters of good performance linked to global prices of commodities rising, that means steel prices going up or iron ore prices going up or aluminium prices going up, doesn't really solve the underlying debt problem. So from that perspective, metals as a space is going to be weighed down by the debt concerns, but in the interim, for a very short period of time, global commodity prices will mean better cash flows for them in quarterly results, and people will closely watch the quarterly results to take positional bets. So metals as a space are like I just said, they're positional bets. You can't really think beyond 3 months or 6 months for most of them, most of the stocks. So if these have already rallied thus far, then it's very difficult to say that the rally will continue in the near term.
Right, but within metals, what would be your top picks, or if you don't have any top picks, any sectors within metals that you are directionally positive on?
So directionally, yes, the steel space appear a little better than the aluminium kind of space. The steel space is simply better because of rising demand locally, better prices, lesser threat of imports. They have been supported by the MPC kind of ruling a few months back, so prices are still remaining up. And in terms of upcoming capex, at least most of the steel companies wouldn't like to go in for major capexes just as yet, or in fact I would say some of the lending institutions wouldn't want them to do more capex henceforth. So all in all, that space appears a little positive.
Right. Did you see the HUL Craft announcement overnight in terms of exploring opportunities? Do you believe even in the Indian space or such large global M&As will lead to a lot of changes into a lot of sectors?
Yeah, it's very difficult to say. Indian markets have. This is not the first time that we are seeing a mega global merger. So that means global giants come together, and therefore there is a corresponding effect in India. So this is not the first time that we are sort of seeing it, but it's very difficult to say what eventually will happen going forward. HUL is a strong local player, irrespective of its MNC parentage and MNC tag attached to it. It's doing very strong locally. So if this merger happens with Kraft, then one can assume that the global business will actually look better for the two companies than really changing the ground level situation in India. So I'm not too enthused about this merger creating value for shareholders of HUL, for example, today.
Right, but you spoke about consumption names. Would HUL be a part of the buy list?
It's kind of a neutral kind of stance, so any dip should be bought in is what we would say. It's also not a stock that you should let go of irrespective of what happens in the market, especially at a time where the index valuations are appearing very high, with the Nifty at 8,800 thereabouts, and the possibility of a correction or a fall remains. Then in such a situation, a stock like HUL is not to be given up. In fact, if at all, you can add into your existing positions.
Right. Mahantesh, thank you so much for taking out time for us. Always good to get a perspective from you.